Most traders fail because they're passengers in someone else's strategy. They follow signals, copy trades, chase the next hot tip. But when the market shifts, and it always does, they're stranded. No clue how to adapt. But you? You already know what it's like to be behind the wheel. Remember when you started trucking? You had a trainer riding shotgun, but you were in control. That's exactly how I'm going to teach you to trade. Most courses try to take the wheel from you. Buy this, sell that, here's the next play. But I'm not here to make you dependent. I'm riding shotgun while you learn to drive the markets. I'll teach you a mental model. Thesis plus structure equals strategy. This framework gives you control, just like the driver's seat puts you in command of an 18-wheeler. When you first backed a 53-foot trailer, your trainer couldn't do it for you. They gave you the setup, the reference points, and watched you figure it out. At first, you sweated through the swings, but after enough reps, it clicked. You didn't need perfect conditions anymore. You adjusted on the fly. That kind of intuition has to be earned by working on your own strategy long enough to feel when something's off and fix it. By the end of our time together, you won't need me anymore. You'll have full control of your trades, your schedule, your risk, your life. Because I'm not teaching you what to think, I'm teaching you how to think. If that vision hits home, I offer a 6 to 8 week ride along exactly for people like you. Links in the description. But let me earn your trust first. Let me show you within this video how this process works. If you're new here, my name is Jeff. I was a CDLA truck driver well over a decade, and I quit to pursue trading full time. Now, in this video, we go over thesis and structure, and I give you an exact breakdown. It's just a small sample of details that we're gonna go through. The reason why this is important, say that your check engine light comes on your tractor trailer, right? We don't throw the whole thing away because one part is broken. We go specifically to the part that is messed up and we fix it. Separating thesis and structure in this way allows us to find what part of the strategy is not working, and then we address that problem. Whereas most people, what they would do is if they struggle with their strategy, they'll throw the whole thing away and they strategy hop and they never make any progress. They end up wasting so much time. That's why we separate thesis and structure. And then within thesis, we break it down even more. And with structure, we break that down even more. And so I give a quick sample example in this video. So please watch to the very end and consider riding along with me. Trading and investing is risky. You can lose all of your money viciously. Why does developing your skills in the stock market matter to you as a truck driver? I'll tell you why. Once you develop a proper strategy with positive expectancy, which is just a fancy way of saying turning a profit, there is nothing between you and the money. No dispatch, no customers, no state troopers, no time clock. You stop exchanging your time for money and you start exchanging money for money. You control your faucet of income. I'm not telling you or encouraging you to quit your stable income trucking job, but if you already have been contemplating it and have been looking for alternatives, but you have not yet found anything worthy, the stock market could be that solution, a solution that you need to explore. There are no guarantees, but just know the market offers endless opportunity. It's just a matter of whether you can carve out your own unique sliver and make it make you money. You have to start small and build on those tiny wins. The hard truth about trucking. In terms of the trucking industry, you think you matter to them? You don't. The second you quit, there's already another driver in your seat. That's how this industry works. It's not personal. It's a system designed to replace you the moment you burn out, get sick, or demand respect. You could give them years of loyalty like I did, but they'll swap you out like a flat tire the minute it's convenient. In fact, they're doing that already. Autonomous, self-driving trucks are here. It's only a matter of time until human drivers get the boot. Then what? What are you going to do? Scramble? What plan do you have in place? I know how you feel. We don't want to walk away from trucking because of the money. There are high-paying trucking jobs out there, but we leave because they give us the paycheck and stripped us of our dignity. They pile on more work, more pressure, and expect us to just take it. They say thank you, but they don't mean it. You get no respect, no humanity. What I'm saying is not just about income, though. It's about how much risk we are taking on for very little reward. It's about risk, reward, and that's also what trading is all about. My trading philosophy. When I trade, I don't pretend to know the future. I study the past because even though history doesn't repeat, it rhymes. And if you learn how to catch that rhythm, if you learn how to hear the music of money, You can move with the market instead of getting smacked by it, instead of having your two left feet stomped on. Let me walk you through the how. In this video, I'm going to teach you the framework that I use to systematically make decisions. Let's get started. Thesis plus structure equals strategy, the framework that creates success. A thesis, as I define it, is a set of conditions that you find reoccurs frequently enough to be worth acting on. When those conditions show up, they trigger you to make a move. So what are those conditions? It could literally be anything. Maybe it's a news event, earnings, a particular chart pattern, a specific time of day. It could be anything you want it to be because the ways to make money in the market are incredibly abundant. If you watch enough trading videos, you'll realize a lot of them promote supply and demand. Although this is popular, there are alternative methods to trade, which in this video you will discover. But let me be clear, one way to make money does not invalidate another way. You'll find people with completely different opinions than you, and yet both of you can still make money on the same ticker in the same trade. It's absolutely possible. The difference comes down to structure, which I'll explain later. Complete example introduction. Now I'm going to walk you through a complete example to show you exactly how this process works. This is a demonstration with a tiny sample size. In real trading, you want 50 to 100 plus data points minimum. I'll be using only 6 trigger points here solely to show you the process. Not because 6 data points is enough to trade on, but it's good enough for demonstration. Our example, CPI and SPY. But remember, your thesis could be built on anything that repeats regularly enough. Once you hone in on a thesis, the next step is to become a historian. Here's why. Trading is a business of uncertainty. As a truck driver, you're already familiar with businesses that make decisions under uncertainty. Banks and insurance companies. These businesses are historians. When you walk into a bank and apply for a loan, they don't give you money because you're a nice person or because you give them warm and fuzzy feelings. They pull your credit history immediately. They want to see what you've done in the past because that's the only reliable indicator that they have to what you might do in the future. Insurance companies control the trucking industry. If you cannot be covered by insurance, you cannot drive. The first thing they check is your MVR, maybe your DAC, and definitely your CSA scores. They check your past to project how you might perform in the future. Now, you'll hear this all the time in trading videos. Past performance is not indicative of future performance. Yeah, that's legally true, but trust me, you absolutely want to make decisions based on past performance. You need to be quantitative. Quantitative is just a fancy way of saying you use numbers to understand something. Instead of saying the stock went up a lot, being quantitative, you'd say the stock went up 10%. The number grounds your understanding. As historians, we need to understand what has happened before to inform us of what could potentially happen next. Does this guarantee future results? Of course not. But if you don't look at the past, you're not trading, you're gambling. You're literally just guessing. And that's a recipe for disaster. Insurance companies would never do that. Banks would never do that. Why should you? If how to succeed in the stock market is your question, the answers that you are looking for reside in historical charts. But are you asking the correct questions when viewing the charts? If you don't know which questions to ask, I will help you one-on-one. Link in description. The data collection process. For our example, we are going to be trading SPY, but using CPI as our set of conditions that will trigger action. SPY is an ETF that represents the top 500 companies in America. What is CPI? CPI stands for Consumer Price Index. It is a report that tells us how expensive everyday stuff is getting, stuff like food, gas, and rent. The government tracks the prices of a bunch of common items people buy, and if the number goes up, it means the cost of living just got more expensive. So if diesel prices go up and your rent just went up again, CPI reflects the quantitative evidence of that. It tracks the cost of living, and in investor jargon, it tracks inflation. Once per month, the CPI report is released and we can track the results on Forex Factory. That is just one source, one way to track it. For our example, let me remind you that we are historians. So for the previous 12 months, we are going to track the results of CPI and its impact on SPY. Here's something important to note. There are big-time Wall Street analysts who give their analytical opinion on what CPI results will be. They give us a forecast into the future. Then, once per month when the actual results come in, the market reacts to the results based on that forecast. Sometimes the actual is higher than the forecast. Sometimes it's the same, and other times it falls short. In this thesis example, we don't care about the result itself. We only care to collect the data on how SPY reacts when the actual is greater than, equal to, or less than the forecast. The question we ask ourselves is, does SPY close higher or lower than its opening trading price? That's it. When we're collecting this data, we stay open-minded. We don't try to predict what will happen. We are simply observing and collecting. After we collect, we put our findings in a spreadsheet and go from there. The research results. I've taken the time to collect the information. Here it is on screen. We collect the data over the last 14 months. We're going to use the oldest 12 months of that data to develop a thesis, then structure a trade, and then use the remaining 2 months to forward test the strategy we put in place. Will we make money or take a loss? Let's continue. From May 14, 2024 to April 10, 2025, we have 12 CPI reports total. 6 of them fell short and came in less than the forecast. 4 came in greater. 2 came in equal. Based on this information, 50% of the previous 12 months in our study saw CPI come in short. This happens enough times that we can use it as a set of conditions to act on. We can use it as a thesis. So now the next step. I have filtered and isolated all the dates where CPI came in less than the forecast. Those dates are as follows from oldest to latest. June 12, 2024, July 11, 2024, August 13, 2024, January 14, 2025, March 12, 2025, April 10, 2025. In Google Sheets, you can pull historical open, high, low, and close of a ticker. In our case, we used SPY. We paired up the dates and now we can quickly see what happened. We found out of the 6 times CPI came in less than the forecast, SPY closed lower than when it opened 5 times. This is valuable information. This tells us 83% of the time within our look back window, when CPI comes in less than forecast, SPY closes lower than when it opened. This is an important reminder. I repeat this again. This is just a demonstration, a tiny sample size. In real trading, you'd use between 50 to 100 data points at least. We're only using those 6 examples here solely to show you the process, not because 6 data points is enough to trade on. Okay, back to our example. With 5 out of 6 days closing lower than the open, our predisposition moving forward is to be short. Short means bearish, and bearish means we expect prices to fall, not go up. Visual analysis of price action. Next, we go back in time and look at each date's price action. There are 6 dates we need to review. At this point, we're trying to see visually what a whole day of price action looks like. We're looking for visual commonalities that will help us develop structure. We are looking for intelligent places to enter, exit, or take profit. If you have questions, ask them in the comment section. We start June 12, 2024. This is a 5-minute chart of that entire day. The yellow dashed line across the screen represents SPY's open for that day. The red dashed line is the close, which is lower than the yellow line, meaning SPY closed lower than the open. The blue dashed line is the highest price SPY reached that day. 10:30 a.m. is the first time price reached the highs. 3:20 p.m. SPY reached the highs again. What we observe with this first chart is that for most of the day, SPY's price remained above the open until the end of the day. Even though June 12th closed lower than the open, it was a near miss. We now look at July 11, 2024. Yellow dashed line is the open, red dashed line is the close, blue is the high. This is a clear and obvious bearish day. The close is way down. The highest high of the day was at 10:05 a.m., 35 minutes after open. August 13, 2024. We see a clear trend day to the upside. This is the only day of our 6 that price closed higher than when it opened. After 10:30, price continued to rise higher and higher. The red dashed line represents the close. It's way above the yellow line, which is the open. January 14, 2025. Price closed lower and the highest high was at 9:40 a.m. March 12, 2025. We have another lower close and the highest high was at 9:35 a.m. Are you starting to see a pattern here? April 10, 2025, the highest high was at 9:30 a.m. the moment the market opened, and we have a lower close. Pattern recognition. Those are all 6 of our days. The trend I noticed with price action is that price falls almost right after market open, within the first hour actually. The market opens at 9:30, and after 10:30, for the most part, if price rises above the first hour's high, then it's likely to close above, as observed by August 13, 2024. And if price holds above the morning session highs, then our bearish thesis should go out the window. I also noticed that price reaches its lowest low of the day before 12:30 p.m. Let's take a look real quick and retoggle through the days. June 12, 2024, the lowest low was at 2 p.m. June 11, 2024, the lowest low was at 2 p.m., but price reached the zone by 12 noon and remained in that area. August 13th, the only day where price closed higher than the open, and the lowest low was at 10:30 a.m. Interesting. January 14, 2025, the lowest low was 12:30 p.m. March 12, 2025, the lowest low was at 11:15 a.m. April 10, 2025, the lowest low was at 12:20 a.m. Armed with this information, we can now move on to develop a structure. So far, I hope that you can see how I can help you one-on-one in your trading journey. If you believe that I'm experienced and knowledgeable enough to advance your learnings, go to the link in the description and book me for a 6 to 8 week ride-along. The power of built-in win rates. Now back to our example. Do you see how, without your involvement, the price already has its own natural built-in tendencies? 5 out of 6 times, which is 83%, under the conditions of CPI falling short, price closes lower. Not only does it close lower, but it behaves in a particular way in between. We can exploit that. We need to exploit that. Matter of fact, this is the essence of making money. Which brings us to the point that thesis plus structure equals strategy. What I'm really saying is left leg plus right leg equals walking. And a mathematical way of saying the same thing is win rate by risk reward equals expected value. Win rate is another way of saying frequency. The natural frequency of this thesis is 83%. Once we start to execute a trade though, our execution will have its own natural win rate, which you will see later. We've completed the first step. We have acquired our left leg, our thesis. When we move on to structure, we will complete our right leg. Then in the end, we will attempt to walk, meaning establish and discover and tweak the expected value of this strategy. Left leg plus right leg equals walking. Win rate by risk reward equals expected value. One thing should be clear to you so far. As a trader, you don't have to trade support and resistance like everybody else. You don't have to have a fundamental, macro, or micro view on why a company is worth buying or selling. Your thesis can be built on anything as long as it is a set of conditions that repeat on a regular enough basis. There are way more alternative ways to not follow the crowd and avoid doing what everyone else does. You can carve out your own unique thesis. In this example, our adopted thesis is if CPI reports less than what was forecast, SPY will close lower than it opened, and therefore we are bearish. We don't have to guess. We have 83% accuracy of data collection backing our decision. That is the power of built-in win rate. We don't guess. We make decisions based on higher probability odds. Understanding structure. What is structure? Structure is the rules you build around your observations. Structure is what happens after the observation. We don't make trades based on gut feelings. We develop rules around what we have already observed. If thesis is our why, structure is our how. The synergy between them is like trying on shoes. You don't force your foot into just anything. You find the structure that fits your thesis comfortably and performs the best. We have a bearish thesis. There are many ways to express that. We can short shares, which means sell first and buy later to cover. To achieve the same objective, we can buy an inverse ETF of SPY, like ticker symbol SH. You can get really creative on the instruments you use to structure. But in this case, because I trade options, I'm going to show you 3 different bearish options structures. 1, the long put. 2, selling an at-the-money call credit spread. 3, selling an out-of-the-money call credit spread. All 3 of these are designed to make money when price goes down. Review our key observations and forward test. Let us review our observations. On CPI days, if the actual number comes in lower than the forecast, price falls almost immediately after open. By 10:30 a.m., price should already have started falling. But if price is climbing after 10:30, that invalidates the thesis, so we don't need to be in the trade anymore. By noon, if everything goes as planned, price is almost always near the lowest point of the day. So now, we take those observations and create rules to plug into our structure to test. We need to find out which one performs the best. Here are the rules I've developed based on our observations. These rules answer 3 questions. 1. When do we enter? 2. When do we exit the trade if price is moving against us? And 3. When do we profit? Let's answer these questions. 1. When do we enter the trade? At 9:45. Why? Because we observed almost immediately price starts to fall. 2. When do we exit the trade if price is moving against us? We exit if price breaks above and holds the highest high reached by 10:30, because that's what we have observed. The moment price breaks above the highest high of 10:30 and it keeps going up, that means our thesis is invalid. 3. When do we take profit? For our long put, we take profit at 12:15 to avoid theta decay. For our credit spreads, we let them expire if price does not move against us, breaching the morning session highs. And now the final rule. Once we enter a trade, we do nothing until a rule triggers us to act. That's it. Those are the rules as it relates to each individual structure. This whole process, from observation to testing multiple instruments to finalizing the rules, is what it means to build a structure. It's not about guessing. It's about measuring, comparing, and choosing the option that fits your thesis the best. Here are the results on screen. As you can see, each structure has its own independent win rate from one another, and from our thesis, the long put performed the best. It gives us the strongest dollar return. It matched the movement of SPY more directly and benefited the most when the move came fast. At this point, we've done enough so that now we take our rules and the best performing structure, which is the long put, and we forward test it. Forward testing just means watching your trade idea play out in real time without putting money on it. You've spent enough time using historical charts to create a strategy, and now you're seeing if it actually works while the market's moving live. It's like saying, let me see if this thing does what I think it'll do before I risk $1. In this case with CPI and SPY, we have 2 future months of natural price action that we did not include in our research, but we will apply our rules to these 2 months to see how what we've discovered, the research that we've uncovered, how that performs. So here we go. Here are the forward tested results. Oh no, that didn't work. We just took 2 losses back to back. Let's just junk the whole strategy. No, we don't junk everything. That's our check engine light. We go back to examine each piece because we built this systematically. What if we traded the at the money call credit spread instead? Would that have gave us the better result over time? Maybe the long put delivers biggest dollar profit when it hits, but what if it's not the best overall approach? What if the real winner is the smaller, more consistent returns of the at-the-money credit spread, where losses are manageable and our wins edge out the losses just enough? Not as exciting, but potentially more reliable. The point is we don't hop around from strategy to strategy. We stay disciplined, focused. We break down the thesis, dissect the structure, and compartmentalize every single rule. That's how we diagnose what went wrong. That's how we isolate exactly each component that needs adjustment, just like troubleshooting an engine. When the check engine light comes on, you don't junk the entire tractor trailer. You go straight to whatever sensor triggered the alert. That's systematic. We take that and we apply that to our trading. You're not stuck. You're not shooting in the dark. You have a process that lets you make precise adjustments. You're not relying on anyone to give you a signal. You're standing on your own because you developed your own. You know how to think, how to do it. This is how you build real experience in the market, not just from the wins, but from understanding exactly why something didn't work. This is exactly what I do for myself, what I can do with you. Together, one-on-one. I hope that you enjoyed this video about thesis and structure. You have an understanding of exactly what we will be going over within the ride-along. And, you know, it is work. The majority of the time you're going to spend developing the structure around your thesis. And I will literally help you along the way. Whatever questions you have, I'll be there to answer it. And at the end, you won't need me anymore. Really, you won't, because you will have the understanding of exactly how to continue forward. When there's an issue, you know exactly how to diagnose that issue. And, you know, I would still love to keep in touch and provide further support. And you can definitely join the Truckers Who Trade community.